morning, students. So today we are going to start with the last topic of your chapter bank, as we were discussing the functions of the central bank yesterday, and we finished off with the functions of the central bank. And among those functions, we studied a very important, a very unique feature of the central bank, that central bank is the controller of the credit in the economy. In any economy, whether it is of any country, if we talk about India, the central bank, the RBI, works as the credit controller or the credit regulator. That means it controls, it keeps a watch on the, it keeps a tab on the money supply in the economy, on the credit flow in the economy. All right. And it is very important for the central bank to keep a tap on the money supply in the economy, because if there is very much fluctuations in the money supply, then it leads to the fluctuation in the value of money, and it will lead to the fluctuation in the prices and other indicators of the economy. So the policy through which the central bank controls the credit or regulates the credit, that policy is known as the monetary policy or the credit policy of central bank. So the policy through which the central bank controls and regulates the credit is known as the monetary or credit policy. Monetary or the credit policy. Now we have to see that what is the meaning of monetary policy. Okay, we will see its meaning, then we'll be able to understand it. So see, what is the meaning of monetary policy or credit policy is telling us. It is saying that it is the policy of the central bank, that in every country this policy, the monetary policy, is formulated and designed by the central bank. In India it is designed by the RBI, the Reserve Bank of India. Why it is designed? It is designed to control and regulate. Okay, see, there are two things: controlling something, controlling the money supply, and regulating the money supply. We can understand this topic very easily. For example, this is the water pipeline. Okay, for instance, this is the water pipeline and this is the knob. And from here the water is coming, and over here the water flows. Okay, and this is the knob. So if we want to change the, or we can say, or we can also show that over here there is a particular tank, okay, in which this water is being filled. So the work of the central bank is to control this knob. The work of the central bank is to control this knob, that whatever money supply is coming, okay, and it is going into the economy, they control it by controlling the knob. They can increase the money supply if they want to increase the flow of if you want to increase the flow of the water, then you can regulate from here, from the knob. And if you want to decrease the flow of the water, you can regulate from here. So that same work is done by the central bank. Okay, that same work is done by the central bank. It regulates the supply of the money into the economy. Okay, how it regulates? So it controls and regulates the money supply, and this controlling and regulating of money supply, it affects the availability. First thing, availability, flow, cost, and use of money. Okay, this controlling and regulating of money supply will affect the availability of money in the economy, whether the volume of money supply is more or less. It will control the flow of the money supply in the economy. Okay, that means where in which direction the money supply is increasing. Maybe in the rural sector, more money supply is required as compared to the urban sector, or in the northeast India, more money supply is required as compared to other regions. Okay, so it regulates the availability, flow, for then cost of money supply. Cost of money supply means that what is the cost of loans, what is the cost of the credit, ongoing credit in the economy. All right, they can increase they have different methods to increase the interest rates, to decrease the interest rates, and with the help of this, they can control the cost of the money supply. And at last, they can control the use of money, that where this money is being used, whether the money is being used in the legal practices, or whether it is being used in the malpractices or illegal practices, whether it is being used more in a particular sector, in the agriculture sector, or whether it is being used more in the industrial sector or manufacturing sector. So with the help of the controlling and regulation of the credit, they can control the availability, flow, cost, and use of money. So for remembering these four things, availability, flow, cost, and use, you can write it short from AFCU. Okay, availability, flow, cost, and use. And why this monetary policy is designed? To achieve certain predetermined objectives, okay, of economic policy. The objective can be anything: to reduce the inflation, or to control the recession, to control the to improve the balance of payments of the country, price stability, anything, whatever problem will be going on accordingly, that will become the economic objective, or the predetermined objective of the economic policy. So this was the monetary policy, or the monetary management, the meaning of the monetary management by the central bank. Now we will discuss that what are the weapons. There are various weapons, or you can call it as instruments, through which the central bank controls the money supply. It controls the availability, flow, cost, and use of money in the economy with the help of various weapons or instruments. Now let us see what instruments they are. So there are two instruments of monetary policy: quantitative credit control methods and qualitative credit control methods. Okay, I have told you that the monetary policy, what it affects the availability, that is A, cost, C, flow of the credit, and the last was your availability, cost, flow, and use of currency. Okay, so when we talk about the quantitative credit control method, okay, through quantitative credit control methods, this central bank is able to control the availability and cost of the credit. Okay, it controls the availability and cost of credit. That is A and C. It controls the availability and cost of credit. The quantitative credit control methods helps the central bank in controlling the availability and cost of credit. Okay, or cost, availability or cost of money. Whereas your qualitative credit control methods, it helps the central bank in controlling the flow and use of money. Flow and use of money. This is the basic difference between the quantitative credit control method and qualitative credit control method. That your quantitative credit control method helps the central bank in controlling the availability and cost of the credit, and qualitative credit control methods, they help in the controlling the flow and the use of the money. There are various qualitative and quantitative methods that we have So students, these are the various instruments or weapons of the quantitative credit control methods through which the central bank controls the availability and cost of the credit, that is your bank rate, repo rate and reverse repo rate, open market operations, that is OMO, and variable reserve ratio. And under variable reserve ratio there is cash reserve ratio and statutory liquidity ratio, SLR. As far as your qualitative or selective credit control methods are concerned, in it, regulation of consumer credit, regulation of margin requirement, credit rationing, moral suasion, publicity, and one thing more is there, direct action. Direct action. All these things are used to control and regulate the flow and use of the credit. So, okay. So in the next period, that is the third period, we'll start with the quantitative credit control methods. So we'll discuss the